Okay, welcome back. We're super pumped for this next session. I'm going to hand over now to Lisa Tay, who's moderating this session, and Matt's going to be speaking here. So have fun, guys.
Amazing. I love that you're already breaking the internet, Ben. Well, my name is Lisa Tay. I'm super excited to be here to discuss a look, I'm competitive, so I think this is like the best panel of the day. The topic is the 4-year cycle, fact or fiction. How long will this bull market last? And I am joined by 3 of the leading voices in crypto in Australia. No pressure, guys. I feel like I'm on a dating show, actually. Introducing you each. But I'm going to get them to introduce themselves. And for something a little bit fun, I'm going to get them to share their best and worst advice that they've received in crypto. So I can see Chris on my screen. So Chris, I'm going to throw to you first.
Thanks, Lisa. Excited to be part of the number one panel for the program. Look, my name's Chris Judd. I run an equities fund called the Serity Macro Fund. We very much focus on macroeconomics when looking at investments. There will certainly be other people far more qualified than us to talk about crypto, but crypto is playing a more and more important role in the macroeconomic landscape. In terms of my best advice I received with crypto, it was to treat it how you would treat insurance. So, every year we pay an insurance premium on our house. I couldn't tell you what exactly that is, but we've got a nice house, call it $10,000, and every year we hope that $10,000 goes to zero. That's 100% loss. But if we have a fire in that house, that $10,000 becomes a 40x or a 50x or whatever it is. So that's a similar way how you could view crypto investing. If you don't want to be the guy wearing pit vipers, just eating meat and reading everything that Mises has ever written, if you view yourself more as just a normal punter, if the system's working for you, that's great, but you might want to recognise that the system may change one day and to have a portion of your portfolio in what you would view as an insurance portfolio for those changes that may or may not come. And the worst advice, I guess, would be listening to Warren Buffett, who's the most brilliant investor and a far greater investor than I'll ever be. But him and Charlie Munger, who's also just a brilliant mind, viewing it as rat poison squared. And I think the learnings from that is just to not have hero worship and blindly follow what other people think. Even the great investors get 40 to 45% of their decisions wrong. It doesn't mean they're not brilliant. It just means predicting the future is really hard. And, with all these things, particularly new technologies, it pays to do the work yourself and not just use that heuristic to deferring to other people who've had success in the past.
Love that. And that's really good advice. I feel like, sometimes, and even with social media, things can be a bit of an echo chamber and sort of just hearing the same things over and over again and you start to believe it as truth. So thank you, Chris. That was some great advice. I'm going to next throw it to Josh Gilbert from eToro.
I want a petition for pit vipers on Chris Judd if we hit 100K by the end of the day.
I actually have a pair of pit vipers, Josh.
That's what I want to see. I'm Josh Gilbert. Thanks, Lisa. Great to be here today. I'm an analyst at eToro. I've been there for 5 years now. I've been involved with markets for just over 10 years and I'm in my third cycle of crypto. At eToro, I do analysis and research to our 35 million users globally, contribute to media outlets such as Bloomberg, Cointelegraph, CoinDesk, etc. Really love sort of trying to break down sort of simplified or sort of complex topics in a simplified manner through podcast videos and things like this. So love what the guys at Collective Shift are doing. My best advice in crypto is just make sure you sell. I know it's something that, as I say, the guys at Collective Shift do preach about a lot. But as they say, you can't go broke taking profits. And I think don't compare what a win is for you to someone else. We're all on our own journey. So I think it's really important that when we sort of start to see those prices, really going sky high, which is what we are starting to see at the moment, make sure we stick to that strategy that we had. Try and take emotions out of it. That's really important. And the worst advice I think I ever had in crypto was to meet Greg Oakford. Terrible decision to meet that man. Not sure whose advice it was, but that was some really bad advice there. So.
Oh no, poor Greg. If you're tuning in, Greg, we love you. So just ignore Josh. I can put him on mute if you want for the rest of the session. But I do love a British accent, so I might throw to him a few times. And last but not least, we have Matt, who is coming to us live from the studio. Welcome, Matt.
Thanks, Lisa. Pleasure to join you. And yeah, a lot nicer here than in my bedroom at home. So yeah, I'm Matt, head of research at Collective Shift. So I manage a team of analysts and we live and breathe crypto. So I've been working full time in the industry for getting up towards 8 years now. So yeah, similar to Josh, just staying on top of the markets and individual projects and sectors in the crypto space. So yeah, looking forward to getting in today's session. Best advice I've received personally in terms of crypto would be to just, I think it's just time in the market. It sounds very simple, but honestly, you'd be shocked by the hundreds of conversations I've had over the years of people who have continued to just chase different narratives and the next hot thing. I think just staying in the market, or more importantly, staying in a certain position, whether it's even Bitcoin or even another major cryptocurrency, just not getting itchy feet and like moving on to, you know, the next hot thing, which inevitably you'll find from time to time really falls by 80, 90% in the worst cases. So that's the best advice I can pass on. And the worst I have received personally, I'm not a huge advocate for diversification within the crypto asset class itself. I think the whole asset class is extremely risky, as we know, relative to others. A lot of potential reward, of course, but I think when you do spread yourself too thin within cryptocurrencies, so having, say, over a dozen individual, you know, tokens and coins, it just gets really hard to manage and know when the best possible time is to sell. So again, I've heard a lot of like, yeah, hard to hear sort of cases from different people over the years who have just had way too many and just gotten over there ahead of their skis a bit. So yeah, that's the worst advice.
Fantastic. And thank you for sharing that. And I guess all of you tuning in are looking at some great nuggets from today's speakers. So without further ado, I'm going to jump into the questions. But I will say, we want your questions. So do not feel shy about leaving questions. Enter them in Slido. You can leave them anonymously, or if you want to shout out, feel free to say hi and I can give you a little shout out. But we've allocated some time at the end for these three amazing experts to answer your questions. So no questions too tough. I feel bad saying that, throwing you guys under the bus. But feel free to leave some in there. And if we don't have the answers, we can obviously go over and chase them down for you. So jumping into the first question, Matt, I'm going to throw it to you in the studio. What indicators should investors watch to determine if a bull market is nearing its peak?
Yeah, it's a tricky one, Lisa, in a sense. Like the cryptocurrency space has, well, technically been around since the very, very start of 2009. But as a whole market, I think most people watching this right now, and even myself personally, got invested first time in 2017. So we really only have like 2 complete market cycles to use as a sample size, really, to go off, you know, historically reliable, you know, indicators. So that's the first thing I will just throw out as a bit of a caution or a bit of a tip for next year to just be mindful of. However, that said, I think for me personally, like a really strong bull market signal that I'm monitoring particularly closely is the social metrics. So again, things like YouTube views, subscriber counts, things like even TikTok engagement, to be honest, these days. They're all, again, just very highly indicative of how many people are getting interested in crypto. Eventually, we'll hit a stage of euphoria. I strongly believe that greed just takes over. And if your plan is to sell and take profits in this bull market, I will personally be, you know, having that as one of my main inputs for my decision making. Of course, you know, we use a confluence of different, you know, forms of analysis like on-chain analytics, you know, sentiment analytics, which is what I just described. Also a bit of technical analysis and then also fundamental analysis. But yeah, the one I would love to highlight is the social side of it. Again, we are all retail investors. I think that word gets overused a lot, or most of us, you know, watching here. But I would say a better way to think about it is like the uninformed capital. You know, where are these people just like FOMOing in or buying based off of just, yeah, excitement and whatnot, getting into the market at like the worst possible time in hindsight. That always just happens. It's just a function of any market, really. And those social metrics are very highly indicative of, you know, when that bull market is sort of reaching its climax. So that's one I'd like to highlight.
Fantastic. Thank you for that. And, you know, I think a lot of people try and work things out themselves where, you know, talking to people like yourself at Collective Shift, it's so useful because you've just analyzed so many years of data. So it just takes almost like the risk out of it. So there's a free plug for you. Feel free to send me some Bitcoin after the show. I'll send you my wallet address. Now, moving on to Chris, how are the worlds of crypto and the real world colliding? Because I feel like a lot of people like, is crypto just an investment vehicle? Is it just speculative? Or are people actually out there like tapping their cards and paying with crypto? Would love to know a little bit about that.
Yeah, well, I think the most important use case currently for crypto is stable coins. It's outside of Bitcoin. It's really important in third world countries where they need a means of payment. Bitcoin's still pretty volatile to use as a payment function every day, and we're seeing in countries with hyperinflation and really poor currencies, more and more people are dollarizing in those countries using stable coins. But also the increasing use of stablecoins is also playing a really important role for the US government at a time when they're running enormous deficits. Those stablecoins are backed by short-term US government debt. And at a time when, countries like Saudi Arabia are preferring to roll their surplus funds into soccer teams and infrastructure projects, post the Russian sanctions on their FX reserves, China's a bit hesitant increasing the amount of US government debt. Russia's not allowed to buy US government debt anymore. So to have a new buyer that's growing really rapidly looks like it's going to be really important for the US. And I see more and more people becoming aware of that. And that's one of the use cases jumping out at me, that it's not just happening in the cyber world now, it's having real world implications for the US's ability to fund themselves. And so that's one use case, which I see more and more people in regular finance talking about now that perhaps they weren't a couple of years ago.
Yeah, I love that. And I feel like, I deal with crypto naysayers on a daily basis. And I feel like, they always talk about the dodgy people doing things with crypto. But what they don't realize is, like, obviously there's a lot of dodgy people doing dodgy things with cash, and you can't trace that as soon as it leaves the bank. Whereas crypto, it's not like you can take like a physical Bitcoin. It's like it's all going to be somewhere on chain. So eventually it can be traced. Whereas cash, who knows where that's going. So that's some really good advice. Moving on to Josh and your British accent. What role does the introduction of institutional investors and ETFs play in potentially altering the cycle?
Yeah, look, I think the ETFs obviously being introduced this year has obviously been a real significant change for crypto assets. And I think when we look back at cycles, the investor base that we've had has changed substantially over the years, right? If we go back to when we sort of first started with crypto assets and Bitcoin, we had this sort of user base of technology enthusiasts. To be able to sort of even get your hands on Bitcoin, 10 years ago, you'd have had to have been a very, very smart person to sort of do that, computer whiz in that sense. It's obviously far easier now. Obviously, periods of huge returns, scalability, use cases, that's attracted a much wider range of, obviously, retail investors, but obviously, as we say, now much larger institutional investors as well. So I think, look, if we do begin to see more institutions continuing to get involved, I think we will then begin to see things like monetary policy and macroeconomics play a bigger role in this as well. It has affected crypto in the past, but with more institutional capital, I think that will only likely intensify. So what I think we may see is a bigger focus on macroeconomic factors. We may see a bit more of a focus on the underlying fundamentals as well from Bitcoin. And I think, at the moment, from a retail perspective, we focused on that sort of 4-year cycle quite heavily. We've always looked at that sort of Bitcoin halving, and ultimately it has always sort of followed that cycle. So it's short-sighted to not think that we won't see that continue, but it's also short-sighted to think that we might not see that change. Bitcoin is ultimately maturing. The 4-year cycle, in my view, still holds its relevance because, as I say, it continues to play out. But as I say, I think if we do continue to see that institutional participation, that cycle, in terms of its impact, it may begin to diminish. We may see that change slightly. It may not continue over the years. But until we see that change, I think it would be, as I say, short-sighted to say that it's not going to sort of continue. But I think it is a key piece of analysis that investors have really got to sort of look towards. Institutional, investment is going to play a big, big role moving forward. When you have sort of the likes of BlackRock ultimately tipping their hat to this asset, it's a massive win. It's the biggest asset manager in the whole entire world. Not only are they launching ETFs, they're now asking or sort of talking to clients about including it in their portfolios. And I think that's completely fair when we think about the performance of Bitcoin. By far one of the best risk-adjusted returns of any asset over recent years. So if there's any debate that this Bitcoin and crypto assets deserve a position in a portfolio, I think we're starting to see that be squandered. But yes, I do think there is the potential to see this cycle alter as we continue to see more institutions sort of getting involved.
After living through the bear, I'm so glad it's the bull now. So thank you for those insights. It definitely makes a lot of sense to be looking at market leaders such as BlackRock to look at what they're doing in the space. So I'm going to keep going with the questions, but I just wanted to quickly tell you guys listening in at home or at work, please send us some questions, because there is no such thing as a silly question. You can, like I said, make it anonymous if you want to, but you have 3 of the best minds in crypto in Australia at your disposal right now. So feel free to ask anything, ideally crypto related, but it doesn't have to be. So moving on to Matt, I'm going back to you. So my question is, does the 4-year Bitcoin halving cycle still hold relevance in today's market, and why or why not? And actually, I know that some people listening in are newbies to crypto, so it would be great in your answer if you could also explain what is the Bitcoin halving in really, really simple terms, so people like myself, especially.
Of course, yeah. It's a word that gets used a lot, particularly in April of this year, which I'll explain. But yeah, the concept of the Bitcoin halving, we have a supply of Bitcoin that is 21 million maximum supply. And yeah, one of the unique things about Bitcoin is its issuance. So how much of the supply of Bitcoin is entering circulation. The pace of that essentially halves roughly every 4 years. That happened, the most recent one, which was I think the 4th time Bitcoin has experienced the halving event, happened in April this year. So we went from, 900 Bitcoin entering circulation every day to now 450 Bitcoin. So yeah, just the pace of how much is entering circulation halves every 4 years. And eventually, in around a bit over 100 years, that will technically come to an end, where Bitcoin miners will start earning rewards just based on transaction fees and whatnot. So essentially, we've seen this real narrative of Bitcoin's price being heavily correlated with the 4-year halving cycle. We've got some great panels even today, and we may get into it in the rest of this session as well, in terms of the material sort of impact of going from 900 Bitcoin entering per day to 450 is obviously nowhere near as drastic of a material sort of change compared to the previous 2 or 3 halvings, even though the price of Bitcoin has gone up a lot since the most recent halvings. So there is a case, and there is some, unanswered questions of whether the halving cycle will continue to play out. By that, I mean, will Bitcoin's price just continue to more or less follow this sort of cycle that it does tend to go on, where towards the halving, a lot of hype sort of drives up, people learn about Bitcoin, and then in the preceding months after the halving, you tend to see historically about 12 months after the halving event, which would be putting us in April 2025, you tend to that's when you're sort of right in the thrust of the bull market. So again, very small sample size, which I want to emphasize to everyone watching. But that's why that is one of the reasons why a lot of people are excited for 2025 in the crypto space, because of those historical sort of reliance on past data. But I think the 4-year cycle, we may get into this soon. I think in terms of the halving's impact, I personally am leaning more towards it being less and less of any significance in terms of people's investment outlook for Bitcoin. Again, just because of the USD or just the dollar amount of Bitcoin that affects the supply side dynamics. I think what's a lot more important, and Chris might get into this soon, is really the macro environment. So yeah, Bitcoin, crypto at large, throughout the 2010s really has only ever existed in an environment of very, very, very low interest rates and pretty nice stimulatory sort of monetary policy, as well as fiscal policy as well. So, I think to see Bitcoin back at all-time highs, even with interest rates now being basically the highest they've been in Bitcoin's existence, is really nice. And to be honest, like if I was to answer your question directly, Lisa, I would say it's not. I would say I have a hunch that it's more so ending the time where we go, okay, price will go directly based off the halvings. But to Josh's point, I think it would be foolish to just be so fundamentally locked in to like yes or no. I think it's important to be a bit flexible with these sort of things. But I'm leaning more towards it being fiction moving forward.
Fantastic. I'm just trying to speedily take myself off mute. Thank you. That was a great answer, and also just appreciate the definition of what a Bitcoin halving actually means, because for a long time I had no idea. So in terms of macro factors, I know, Chris, you do a lot of work in this space. Do you think macro factors are more or less important compared to the Bitcoin halving?
Oh, I think they're probably of equal importance. I mean, I think Bitcoin halving has still a really big role, because it's becoming more scarce than it was the halving before, but it's also psychologically really important to a lot of investors. But if you look at when the halving takes place, that takes place in presidential election years, and we've seen that. It also coincides with the debt refinancing cycle, which is viewed by many as really important as well, and a broader liquidity cycle. So Michael Howell, who's a bit of a market leader in liquidity metrics, talks about an 8-year liquidity cycle from trough to trough. So what that means is that at year 4, that liquidity is peaking. His model has that peaking around September or October next year. And liquidity means different things to different people. For some people, it means money supply, like M2. There's the net liquidity model, which is central bank balance sheet, less the Treasury General account, less the RRP in the US. And Michael Howell's is a bit more complex, where he uses bond volatility, and if the US dollar is strengthening, that's reducing liquidity as well. So you can choose directionally how much weight you want to put in on that, but I think it's a good idea to not just look at the Bitcoin halving cycle, but have some broad understanding of liquidity metrics that directionally can assist you as well. One of the things to note there is when the TGA reduces, that's liquidity into the system, and we have a significant reduction required for that TGA between now and early next year, as the US government needs to renegotiate their debt ceiling. So I think that's about $400 to $500 billion in liquidity coming into the system. And I think that there's these sorts of nuanced things, along with policy changes, which are wildly significant, that people should look at. But I think it's worth just harping on what Josh and Matt pointed to. Whilst the cyclical nature of Bitcoin and its price appreciation looks really predictable at the minute, those things work until they don't. And you should never feel too certain that just because next year in Bitcoin's very short history is forecast to be a big year of price appreciation, it may turn out like that. It may turn out there's 2 more years of price appreciation. We actually don't know the future, but you need to be aware of the past if you've got any chance.
Fantastic. And then talk of macro factors takes me back to university economics, where I was learning all about micro and macro, and I don't even know what I remember from uni. But and I know that you mentioned Michael Howell. I think you said he was a great resource for liquidity analysis. So definitely check him out.
Cross-border capital is his stuff. He's got a Substack that's really good, and a few different products. So if people are interested in some liquidity expertise, he'd be a good one to check out.
Fantastic. Good recommendation. Now, Josh, I'm going to ask you a question, which I feel like everyone wants to know, because, of course, we all want to make a lot of money. How long will this bull market last?
Well, that is the big question, isn't it? How long? I hope for a long time, as Juddy said. Hopefully it goes on for a couple more years. Look, I think to put some context in the cycle, obviously, here at eToro, we're sort of a retail broker. So we look at that retail interest, and we think retail investors still have a considerable role to play in this market. I mean, even though we've spoken about institutions a lot within the last year, obviously the introduction of those ETFs, again, that's made it easier for retail investors to access it. It's sort of legitimized the asset a little bit, although everyone here today would have obviously known about that legitimacy in the past as well. It's, again, something that's maybe helped some retail investors. But I think what's important is that we've seen how big retail investors are to global markets. Even if we look at equity markets over the last 5 years, we can just look back at sort of the meme stock era. That tells you exactly how big of a role they sort of have to play. That was sort of them sort of crushing Wall Street and sort of stepping on the big guys, and everyone loved that. Retail investors are smarter than ever before. They have easier access to better research than ever before. And I also think they feel more comfortable to invest than ever before, having conversations and things like that. But I'd say I wanted to put some context on, how long this bull market will last, and maybe some context on where we are within the bull market, just looking at some of the data that we have internally. So when we look back to November last year November 2021 to this year. So we go back 2021 November, that was when we saw sort of Bitcoin hit that sort of record high of around about 69,000. We're actually at half the positions now for Bitcoin than we were in 2021. So we're seeing half the amount of trading on Bitcoin as we did in 2021. So that's a significant change. And also the value of those positions was 1.5 times higher in 2021. So that's still a big shift. So clearly we've still got retail to come back into this cycle. And for me, that signals that we've still got legs in this bull market. We're not seeing that wave of retail interest that we have in previous cycles. For some context to that as well, at that time in 2021, US rates were at sort of 0.25%. So that's obviously a huge difference in terms of monetary policy, in terms of capital flowing into the market. We're obviously at a completely different period now where we've had rates, near decade highs. But the view is, if we do see rates continue to fall, markets are pricing in about 100 basis points worth of cuts in the US in the next year, then we'll continue to see more capital sort of flow in. And I think we'll see retail interest continue to pick up. The US economy is in a good position. And I think the market environment that we're seeing at the moment is just clearly risk on. Everything is at record highs, but it doesn't feel right at the moment to go risk off. I think the only thing that can really slow us down is maybe something like a black swan that we always sort of have to pay attention for. On the other side of that, just to sort of take a balanced view, we also do have this, slight fear that we may see inflation rear its head over the next year. Maybe, this is maybe a bit of a bold prediction, maybe a bit of an outrageous prediction that we see next year, but maybe we don't see rates lower as quickly as we expect. Maybe we don't even get a rate cut from the Fed next year if inflation does pick up, and that would then have a big impact on risk assets and particularly crypto. There's obviously a lot being priced into rate cuts. Trump is obviously fantastic. We know, getting rid of Gary Gensler, huge, fantastic new SEC chair coming through. One of the big reasons we are where we are with the crypto assets at the moment. But as I say, bold prediction, he could also be a bit of a negative at the same time, especially if monetary policy does have a big part to play. If inflation does rear its head and we do see rates not coming down as quickly as we may think, then that could have a bit of an impact on crypto assets.
Well, it's interesting with Trump, and obviously Elon was a big backer of his campaign, and we all know how much Elon Musk loves crypto, Doge in particular. So I think he'll hopefully maybe have some input into what happens in that space. Please keep your questions coming. Daniel, thank you for your question. You actually asked the question that we had noted down, which was how long do you think the bull run would last? So thank you for asking that. Guys, I can see your questions coming through. Thank you. Please keep them coming. I'm actually going to throw to you, Matt, because Josh has touched on this slightly, but I'd love to know your thoughts on how things are likely to be different this bull run versus previous bull runs.
Yeah, of course. I think Josh did a great job of summarizing the institutional adoption or increased institutional adoption this time. So that's where I start in terms of what's different between this time and the last bull market and the one before that. And in particular, I think one that I'm paying attention to is the retail interest, as Josh said. And all of our metrics are showing it is still nowhere near the heights of, when we're in lockdown, or here in Melbourne at least, throughout that time when crypto was really taking off, very stimulatory environment. Those metrics are nowhere near those heights. So that is absolutely a different factor this time around. So are people going to come back with as much vigor as they did like a few years ago? A lot of people, unfortunately, lost a lot of money with the likes of FTX collapse at the end of November, around November 2022. We also saw the likes of Terra, Celsius, many other sort of bankruptcies, where unfortunately the industry and the asset class, really the reputation got absolutely pummeled, unfortunately, even though they were just companies that were attached to the underlying technology, but is what it is. So I'm still really focused on, okay, are we going to hit those heights we have hit? And if so, or if not, what are the implications? And probably another reason that I would say this time is very different to previous bull markets is also, again, as was touched on as well, the US government. So I think, as Josh said, there's a lot priced in to what will happen in 2025 and beyond in terms of the Trump administration and their views on crypto and to what extent they will support Bitcoin and the crypto asset class. It's been a lot of promises, but I think time will tell whether those actually come to fruition. And that's what I'll be watching closely. If they don't come to fruition, I would expect a bit of a re-rating or a bit of slide in prices. But all indications at the moment are showing that Trump is actually going to deliver on a lot of his promises, and that is absolutely a different factor than we've ever had before. A US government seemingly being pro crypto.
Fantastic. Thank you. And I can see lots of questions coming through now. So thank you so much. Chris, I'm going to actually ask you one of these questions because I think it's literally perfect for you. So what are the biggest macro indicators that affect crypto and why are they important? Great question by Anonymous. Feel free to put your names if you guys want to shout out.
I think liquidity and money supply are the biggest factors that affect crypto. And even if you were to look at Bitcoin per se, it's sometimes good to think of Bitcoin as a percentage of the monetary base. So it's not so much that Bitcoin price is going up, that monetary base is expanding and the denominator is becoming less valuable. And lots of people speak about that. But in, post-COVID years, generally money supply in the US goes up about 7 or 8% a year. In the COVID years, it was up 25% in 1 year and 40% over 2 years. So these are just astronomical numbers. And we could see the, just what that did to prices of most risk assets, but crypto being a highly scalable asset that has characteristics similar to money, it seems to be particularly sensitive to liquidity metrics, much like gold is, but an even a more alpha version of gold, where the liquidity and money supply really has a huge impact on its price.
Fantastic. Thank you for that. And I feel like, you're the macro king. So if anyone's got any other macro questions, feel free to submit them for Chris. In terms of the next question, Josh, I'm going to go to you. So we've had a great question come through about government reserves. And the question is, do you think government reserves could see the end of bear markets?
Yeah, look, good question. I think if we do see it added to government reserves, I think we'll ultimately see the volatility sort of probably move away. Particularly, we're already starting to see volatility not diminish, but obviously, if we look at the cycles in times gone by and we look at sort of the returns, it obviously has, sort of come down significantly. We are sort of starting to see, less volatility in terms of price swings either way. And that is because we are starting to see institutional capital come through. We're starting to see the asset mature. But I think, if we do see, say, the US government, for example, if they do seriously contemplate adding Bitcoin to, its reserves, I think we get to a period where you're not going to not see this asset fall in price. We see that from the likes of gold. Gold is in pretty much every reserve bank across the world, but you still see that the price fall from time to time. But I just think we start to see the cycle sort of change completely, and we start to see the volatility sort of level out a little bit more. We don't start to see those swings, and as we say, that 4-year cycle I think then diminishes. The asset becomes more efficient. We obviously have far greater regulation. We'll have far greater sort of frameworks in that side of things as well. So I think in terms of sitting here and going, great, we're in a bull market, we're in a bear market, I think that's what changes. We don't sit here and say that really gold's in a bull or a bear market. We maybe just say that gold is sort of having a good year or it's having a bad year. I don't think we really ever look at it like that. And a lot of what we see is when sort of gold is particularly doing well is we can look to central banks buying. So over the last sort of couple of years, one of the one of just many reasons why gold has done particularly well is because China's central bank has been sort of buying gold by the boatload. So I think there's definitely going to be a change in the cycle if we see it added to reserves, and that is going to be because obviously regulation will change completely, and the framework we'll have in place will be completely different as well. So I think that volatility changes, and therefore I think the swings in terms of volatility up and down will change. So again, in that sense, I'm not sure whether it's a good thing for crypto assets, right? We've always wanted this to be sort of a decentralized asset. We've always wanted it to sort of be sort of a break away from the monetary system. And I think, for example, at the moment, the debt ceiling sort of highlights crypto's utility and sort of why Bitcoin was sort of brought into place, in and around sort of the GFC times. So I think it maybe isn't something that everyone in the space would want to see. Matt or Chris might be able to sort of jump in there, but I absolutely think if we see it added to government reserves, then it will change, crypto for good.
Fantastic. And thank you for that. I know it's interesting to think about whether we even want bear markets. I think maybe we do need that leveler, as painful as they are. But speaking of something else that's painful, it's the end of the panel. So I really appreciate everyone who's dialed in today. Thank you for those who've submitted questions. Please give you won't be able to hear the round of applause, but please give a clap to I'll do that. I need the applause button. Woo! Big thank you to Matt, to Chris, to Josh, to the team at Collective Shift for having us today. You're doing amazing work putting on educational sessions like this, because obviously there's a lot of money to be made when the bull market hits, but there's also a lot of money to be lost. So make sure you reach out to companies like Collective Shift, because ultimately we don't want people to have bad experiences with crypto, because it is something that is going to change the world. So thank you everyone for tuning in. Feel free to reach out to any of these people, follow them on LinkedIn or social media. They're very active in the space, so we'll always have some interesting insights.
Thank you so much,
Great
Lisa.
job, Lisa. Thank you.
Thanks, Lisa.
Chris and
Thank you.
Josh, really quickly, do you guys want to just give a quick 10-second where they can find you elsewhere? Chris and Josh and Lisa.
Thanks, guys.
Oh yeah, thanks. If you want to give a bit of a plug, Josh, where people can find you.
Plug for me. I'm quite active on LinkedIn, quite active on X, or just head over to sort of the eToro Academy. We've got sort of plenty of guides there on crypto markets as well. Or I have a podcast as well called Digest and Invest. I usually drop some alpha on there each week, so feel free to head over and listen to that. But if you have any questions, feel free to ping me a message or see me on the golf course, I guess.
Amazing. Thank you so much. What a session. That was absolutely awesome. The 4-year cycle. You heard it here. Josh is calling the bull market. So thank you so much, everyone. And you can find Lisa if you're after any Web3 marketing things for your project or your business. Check out Lisa, Chris as well with Judd Invest. You can follow him on socials. And Matt obviously is wearing the Collective Shift shirt. So we're about to take another break, but I just want to say, hey, well done and thank you. There is over 1,000 people watching right now, which is absolutely bananas. There's about 500 or 600 of you on the Zoom. Twitter's going nuts. There's 300 odd live on the Twitter. The YouTube's going as well. 1,000 people is way more than what we ever expected. So thank you so much. Hopefully we can bring the agenda up if that's going to work. But right next, we've got the institutions are here. So we've got Pratik from Apollo Capital is going to come in and speak. We've got Samira from Elbait. We've also got Greg Oakford, who looks like he's running somewhere from an airport somewhere. I don't know, he's got his backpack on. That's going to be pretty fascinating to see how he goes with that. Looks like, I think his flight got delayed. And we've got Simon, who's going to be moderating, who's one of our senior analysts. So we're just going to take a 2-minute break, toilet break, grab a coffee, see you back in 2 minutes, and we'll get sucked back into it.